Hi, thanks for joining me today as we discuss the fifth principle in my book, The 7 Timeless Principles of Investing. And this principle is avoid following the crowd. And here's one of my quotes. When everyone's discovered a good deal, it's long since gone. Of course, all astute investors really know that. And we saw back in the late 90s, there was a mania going on in terms of the internet, and it really did cost people a lot of money. And you may wonder, how can I identify a mania so I can avoid it in the future? And I'd like to cover a few of those points right now. Number one, that a mania is characterized by a rapid and extreme run-up in prices that's not really justified by the fundamental values of the investment. Secondly, it becomes common knowledge that this is the sure thing. And thirdly, it becomes open to anybody to invest. There's a pathway for all investors, even the very small investor, to get their money into this sure thing. And then finally, that those who give a warning about it are seen as fuddy-duddies. They're old-fashioned. They don't really know what they're talking about. And we certainly saw all of that in the late 90s when it came to the internet problems. Now, there's a time when the crowd is right because there are some people that you do want to follow. And generally, these are what we call the smart money. And if you look at what a company's doing with its own money, if it's buying its own shares or selling its own shares, you may want to do the same thing. Or the people that work inside the company, the directors and the employees of the company, if they're buying or selling, that may be pretty good. But by and large, if you look at the broad consensus, you generally want to go the opposite way. And how can you do that? You can look at investment surveys. Whether people are too bullish or too bearish, you want to go the opposite way. Another thing is to look at the cash levels in mutual funds. If they have too much cash, they're afraid, that's probably a good time for the market to go up. And then we'll look at the cost that investors have to hedge a particular investment. The more costly it gets, the more likely it's going to be going the opposite way. And then track financial headlines. Often if they all become just one headline, you can almost count on things going the other way. It's very important to avoid following the crowd. The reason is the crowd is generally wrong at major turning points, and you can save yourself a lot of trouble in your life if you do that. Thanks for joining me in this segment of 7 Timeless Principles of Investing.